I am Stephen King. I'm the director of the CNY IBA, which is the International Business Alliance in Syracuse. I'm going to go through a little bit about what we do. The bottom line, we are the hub in the region to help companies develop their exports. We're actually part of an organisation, some of you may know it, Sensei CEO, which is, I call it a super mega chamber of commerce in Syracuse. There's probably 120 people, I think, now working in the chamber there. Economic development, all sorts of programs are going on with Sensei CEO. So the International Business Alliance formed about 20 years ago. Got together 6 years ago with CNY, with Brookings, the institute in Washington DC, and Sensei CEO, and we put together a Metropolitan Export Initiative to figure out a way of helping companies in the region export. And what they found was that from the analysis they did and the research around the region, there's a lot of fragmented export resources there, but people didn't know about them. I'm sure everyone in this room, if you think about exporting, you'll think of a few people that might be able to help you, but you probably don't know, maybe a few percent of what there really is. We were underperforming in the region compared to the nation. We were doing about 6% of our GDP was exports, and the country was doing nearly 9%. So we were under the curve. And they also found that a lot of exporters, anyone that's exporting, has a lot of fear. It's the fear of the unknown. There's lots of things happening out there, and they don't know how to really do things. So the knowledge gaps are causing fear, and then they're hesitating exporting. And there's an export culture, but it's sort of fairly weak. We have, in the 12 counties, I'll show you a quick map in a second, we've got about $8 billion worth of exports in the region. So not that we're not exporting, there's quite a bit of exporting, but it's not enough, and the culture that goes with it is still on the weak side, or was on the weak side. So we created this plan called the Metropolitan Export Initiative. So we cover this area here. The IBA covers 12 counties, right up to the St. Lawrence River, down to Ithaca, nearly out to Rochester and out to Albany, nearly. So we do a lot of outreach meetings. We come out, if any of you are in business or you have connections with business people, just remember us, because you can help those companies, those connections to develop their exports. We do a lot of outreach every year. Probably it may sort of be somewhere between about 200, 220 or so outreach meetings, meeting companies multiple times. We have programs called an Export Catalyst program that actually drops in consultants into companies to help them. We have education, and we do events. So we have about 15 events a year where companies can come and learn about all sorts of different things we're exporting. We also have an educational program called the Export in New York program, which is a 4-month program. It's actually 8 one-day sessions at the Whitman School in Syracuse, and that program is a really, really great way to get into exporting. But if you've been in exporting for 20 years, it's also another great program to go into, because it really covers a lot of up-to-date things that are going on in exporting and help you figure out how to do it, give you a lot of comfort. Resources and connections. I've got in my phone something like 2,700 names and connections to people. That's just my export phone, just to help the region's exporters. So if any of you need to figure out how to sort out for an exchange, or get a letter of credit done, or go and find a buyer overseas, or get some money for grants, we can help you directly. And we also have this big mountain of people that we've met and we've connected to, not just companies, but people in those companies. They actually help you with any particular issue that you have. It's really, really powerful. So we can punch way above our weight using that resource mountain. We have membership. We've got nearly 70 members in the IBA now. They're service providers like logistics and attorneys companies, but they're also a lot of exporters. 2/3 of our membership are made up of companies that export. Exporting services as well as goods. It doesn't have to be manufactured goods. It can, bringing Chinese students into the region to study here is actually an export, for example. So that's services. We've got all sorts of projects. We had $400,000 from the International Trade Administration to help take companies to Asia. So there's a lot of things going on there. I haven't got much time, so I'm going to speak fast, and if you lose me because of the accent, I'm sorry. So examples of assistance, I'm not going to go through the list, but there's just lots and lots. Any area that you can think of, and a lot of areas that you definitely haven't thought of, are covered in what we do. So in there, China, we've got companies that are having problems with counterfeits in China. You want to do contracts with your distributors overseas. You want to build business plans. You want to find buyers. You want pricing strategies. You want to figure out what your Incoterms are and how you document your international documentation so that you can get the products out there properly. You want to make sure that your product doesn't go to North Korea, because if it does, you get 20 years in prison and your organization gets reduced to rubble, because obviously there are sanctions and regulations that you have to follow. So we help companies with, I've helped a couple of companies avoid jail because they were planning on shipping to Iran, for example. Yeah. Can you imagine? People not reading the newspaper, not really realizing that Iran's a banned country. But, so we've helped a lot of different ways there. Finding buyers, that's a staple that we do. There's a lot of resources out there that we can help you find buyers with. And there's grant money as well. We've got access, these days there's now $63,000 that I can find companies that are interested. If you're interested in exporting, I can get you grants up to $63,000 for the next 12 months to help you pay for plane tickets, for hotels, for trade shows, for trade booths, for certification, for all sorts of things that will help you exporting. That's just an example of resources that are there, but if you don't know about them, you don't access them. So that's why we're here. So this is our resource mountain. We're just reaching out to multiple. There's so many different areas that we can connect you with, whether it's US government resources, whether it's people in the Canadian government, for example. We've got connections all over. Exim Bank to help you with payment challenges, just all sorts of things there. This is the Export New York program. We've actually, if you're interested in exporting or you're doing it and you want to really polish your expertise, that's it. Our next program, we do 2 a year. Next one starts in February. There's 30 syllabus subjects. It's $4,900, but we can actually help you get grants. We'll bring it down to $1,495, and you can have 2 people from your company at that one price. We can actually probably find you another grant that'll take that $1,495 down to 0 as well. So all that's available. And the program has interns to help you build export plans. And we only keep it to 8 companies because it's very intimate, very proactive, a very interactive program. It's not really academic, it's really practical. But a great program. It's been going 20 years this year. A lot of great companies through there. So if I have just a few seconds more, I just want to show you a few little bits of data. We've got all sorts of data out there. But our region, our 12-county region, this is just on the next 2 data level. We've got about $8 billion worth of exports. Agriculture, forestry and fishing is classified in one NAICS code there. And that makes up $285 million worth of that 7.9 billion. So this includes goods as well as services as well. So education, surgeries done on Canadians that come to hospitals here, that's all included here as well. So interestingly, agriculture makes up 3.5% of our exports. Actually makes up a lot more in terms of the number of jobs that it supports. So there's actually 28,000 people in this region, in these 12 counties, that are dependent on exports for their jobs, and 5.6% in the agricultural sector. That's quite an interesting piece of information there. This is just Syracuse, it's not the whole region, but this is just to give you some quick trend lines here. Our exports are now, in Syracuse, it's 8 billion for the region. Syracuse, it's 3.8 now, it's sort of been going up. The trend is upwards with the US last year and the year before. The US was a little flat, but Syracuse and our region was actually growing. We're starting to close the gap a little bit. It takes a bit of time to do that. It's a big oil tanker out in the ocean. And compared to Buffalo and Rochester, Syracuse and our region here has been outperforming Buffalo and Rochester for the last 13 years, I guess. Back down to 2003. So that's all going very well. There's trade wars and things, but I'll leave that to the panel discussion. You may have noticed there's something going on this year. And that's affecting agriculture and many other things in exporting. Okay, I'll hand over to Derek.
Okay, I'm Zach Harding. I'm a senior local manager or local merchant at Lansing Trade Group here in Auburn. As Derek mentioned, soon to be Anderson's Trade Group. We were wholly bought out by Anderson's a few weeks ago. So that integration will happen here at the first of the year. But as of right now, we're still Lansing Trade Group. A little bit about me. I grew up on a small beef farm in central Pennsylvania, about 50 head of Angus beef cattle. Went to Penn State, graduated in '09 with an ag business degree. And since then, I've been working for Lansing in commodity trading. I started out in the Midwest. We traded corn, wheat, sorghum, and a little bit of soybeans in the Midwest states, Nebraska, Kansas, Oklahoma, Texas. Moved from there into our export group. I worked out of Columbus trading export containers all over the world, mostly Southeast Asia, China mainly, Malaysia, Thailand, Taiwan, those countries. Moved into our energy group and traded ethanol for about 6 months. Learned a lot about the ethanol side and the gas side of the industry. And then lastly, I spent my last 8 years up here in Auburn trading Northeast grains. So corn, soybeans, wheat, small grains, barleys, and oats, and a little bit of feed ingredients. So what is Lansing? Lansing is an international commodity trading firm. We buy and sell physical commodities, so none of the paper stuff, although we do use the Chicago Board of Trade, New York Stock Exchange for hedging instruments and stuff like that. But we are, in essence, a physical commodity trading firm all over the world. We have 15 domestic offices headquartered out of Kansas City. Then we have 5 international offices. I don't know if I can name them, Brazil, Singapore, Thailand, London, one more, can't remember, all over. And so how do we do it? What is our real goal at Lansing? We like or try to offer a complete supply chain management solution for producers of ag products and the users of those products. So we go to the farm level or the production level where the commodities are produced and buy from them through either forward contracts, spot contracts, or a number of marketing and risk management solutions as far as planning is concerned. So there's a lot of planning that goes into that. We provide transportation, whether that be truck, rail, barge, or bulk vessel. So we line up all the transportation and we take care of that, insurance and everything that goes along with that, Stephen knows. And then we connect those original customers to feed mills, ethanol plants, and all of the export world. So here in New York, we export a vast amount of our soybeans. That's been the big talk with the trade war going on recently. So that'll be a focus kind of as we get into the discussion. But that's a big part of our business is taking we are the breadbasket here of the world and taking those and supplying them to other buyers outside. And overall, we try to remain as customer focused as possible. When our customers are not successful, our business fails to exist. So the farmer needs to make money, the end user needs to be making money, and in order to do that, we have to provide the most efficient supply chain that we possibly can.
Okay, hello. So my focus is going to be on dairy, and I think what I was asked to do is to try to talk about how the opportunity to export impacts the domestic dairy industry or domestic markets, but also how being on global markets in and of itself, separate from just being able to sell to a foreign customer, has implications for the U.S. dairy industry. And you can't talk about what's happening in the dairy industry without bringing in a few other things that are going on at the same time. This chart, which is the one that I just changed to put up front because I had this brainstorm that maybe that might be useful, is showing us 4 basic characteristics. This blue line is the production of milk from 1970. This kind of looks sort of reddish orange line is domestic usage of milk. It includes territories, so it includes Puerto Rico, and trust me, that's not so big, but that isn't actually an export because it's not actually a foreign country, so I include that as part of our domestic. Down here, kind of hard to see, the orange line is exports and the green line is imports. For those of you who are kind of dairy nerds, this is based on milk fat equivalence, so it's saying how much milk fat was there in the exports we sold, how much milk would you need to generate that amount of fat. If I showed you solids not fat, it wouldn't look quite the same. We'll get into that. But what I wanted to kind of convey to you is I think any normal person who didn't see a header, didn't know this was milk, just this is widgets or automobiles or whatever, would say, oh wow, yawn, doesn't look like much is going on here. And if you ask the question, do you think, what do you suppose is a price pattern if this is sort of the big measures of production versus sales and how trade comes in? We're looking at 40 plus year period. Would you expect that this would be a market that had prices going all over the place? And I think most people would look at that and go, gosh, why? I mean, maybe a little inflation or something, but why on earth would you have any kind of price movement? This doesn't look like there's any drama going on here. Well, we who follow dairy at all know that there's all kinds of price movements, from times when are pretty exciting and fun to times which are pretty scary. And how does that fit in with this kind of basic market performance? What on earth is causing all of this? I have an answer that isn't really that much of an answer, but basically very small changes, very small differences between production and consumption have large price swings effects because it takes big price changes in order to get people to produce differently or consume differently. When you think about the production side, what causes somebody to make an investment, which, when you think about investing in growing your farm business, you don't say, oh, I got 100 cows, I think I'll go to 110. You start thinking about, I'll go to 250 or 500 or 1,000. Or you think about making bigger jumps. It's not, some tiny little thing. If you think about consumption, I do this at a lot of meetings, especially when it's not farmers so much. And I ask people, how many of you are milk drinkers? And people raise their hand. Okay, so raise your hand if you're a milk drinker. Everybody's going to raise their hand because they don't want to get embarrassed, right? Okay, so you buy milk in a grocery store. How much did you pay for milk the last time you bought it?
A lot, because we buy the, organic and stuff, but it's probably like $5, over $5.
Okay, you buy milk? Mm-hmm. Yeah, how much did you pay?
I don't know.
Yeah.
I buy it no matter the price.
Right.
Bingo! That's my point. I do that too. I mean, if I went to the checkout counter and the clerk said that'll be $5,000 because the price of milk went up, I'd be paying attention. I don't look at the price at all. I just pick out what I want. I put it in a basket and I drink it. I mean, and if the price were half, I wouldn't buy more. If the price were double, I wouldn't buy less. Now, income isn't a big problem for Cornell professors, but there are some people where small changes in price might be more meaningful. But I think a lot of folks who are buying dairy products are not particularly price sensitive. So if you've got a situation where the line is wiggling just a little bit, for whatever reason, it takes a big price move to either change how much is produced or change how much is consumed. And so this is kind of the world that we live in. On the upside on dairy, you're inspiring investment. That's pretty much how we grow. On the downside, you're putting people out of business. Both of those are long, hard decisions. You don't do that just because you're excited for a couple of months or depressed for a couple of months. This is a long-term decision. You don't make those lightly, either on the exit side or on the expansion side. I won't belabor this because I think I've made a lot of my basic points, but I'm going to show you 3 tables that have this kind of complicated format, and I'll just try to highlight a couple things. So first of all, let's see, this is the pointer. This is about where we get milk from. So we get milk from producing milk. We get milk from stocks that we carried over from the year before. We get dairy products from imports. We also have become a lot more sensitive to the fact that when you're doing the apples and oranges, adding up to some fruit equivalent, you can do it on the basis of how much fat is in a thing, or how much what we usually call skim solids, which is just say everything that isn't fat, which is of course is protein and carbohydrate. And it's not quite the same number. So, milk is milk. When you look at production, it's just production. There's no skim solids equivalent. But when you look at imports, we're looking at 4, 5, 6, 6, 6. That's the order of magnitude. when you're looking at exactly the same imports, this is not different stuff, it's all the same stuff, but now we're saying how much protein and carbohydrate is in this imports as opposed to how much fat. Now we're looking at 5, 6, 6, 6. It's not quite the same number. It's the same stuff. It's the same pile of stuff. It's just measured a little bit differently. The other thing that I'll kind of draw out to you is look at the year-to-year jumps. So we went up a little over 2. We went up about 4. We went up about 3. We went up a little less than 3. Now we're projected to go up about 3. Doesn't seem like much difference. The long-term trend in increases in milk production is 3 billion pounds per year. If you're a little above trend, you're pushing down on price. If you're a little below trend, you're pulling up on price. And take my word for it, 2 is a big difference from 4, if 3 is kind of the average. And so these things that don't seem like that big a deal really kind of make a pretty big difference. 2014 was our last really good year, but since 2015 we've been increasing production generally a little bit above trend. And so that's the beginning of pushing a little bit downward on price. If you look, this is of course the year-over-year depiction of production, so this is 2015, 2016, 2017, 2018. So the first thing we see is it's an upward line. Every successive year is higher than the one before it. You don't see 2015 going below 2014. So the key here is when is it kind of spreading and when is it squeezing? So when we look here at 2016, we start to see it widening. It's paralleling and now it's starting to get widening. We come in at 2017, it's kind of wide. It sort of narrows a little bit. Now all the question is what's happening in 2018? Well, this line clearly looks a little closer than some in the previous years, so that would kind of suggest maybe this is a year when prices have a chance to improve a little bit. And in fact, in 2018, we did see some improvement. It was nowhere near what everybody would like, but it definitely started to feel like we weren't declining. We were starting to pick up a little bit. When we see movements like this, we start to get a little more optimistic that, oh, maybe we're finally getting things a little bit more into balance. Those little subtle differences are really key indicators that analysts look at. If you look at the 2019 price forecast, you see more optimism. Maybe not where everybody would sort of hope it would be, but definitely this is providing some optimism. This is now looking on the usage side. So what are the basic categories of how we use product? Well, we export some. There's some that go back into storage. There can be possibilities of some going into government programs. That used to be a really big thing in the middle of the 20th century. Not so big a thing now, but we're actually talking about some small programs to increase government donations. And you see that in this little number over here. And then we've got commercial use, the big category. So whether you're looking at a fat-based or a skim-based, these numbers of domestic use are the big numbers. Again, on the usage side, you're looking at the same pile of stuff. We eat cheese, we drink milk, we eat butter, but when you measure it on a fat basis versus a skim basis, you get slightly different numbers. You see this especially now on the export side. This is a number that's kind of floating upper plus or minus 10, and when we look at this, we're on the skim side, we're looking at a number that's right around 40. So you'll see a chart of that makes that really pop out, but there are the numbers. Okay, we won't get into that. The other thing that we find out when we pay attention to this, what are we eating, and trying to add it up into a milk basis, is how are we doing in dairy product consumption? Well, this line is population growth, and the big if you ask me what is the single most important thing that drives domestic consumption of food, I'd say population. There's just more people will eat more. That's kind of true for every category. If you like kumquats more than you like Brussels sprouts, maybe that makes a difference. But the big thing is just simply population growth. And you can see that in both cases of whether you're looking at skim solids or fat, it kind of goes up with population. But the fat side is going up faster than the skim side, and especially in these last few years. With all of the anxiety about fat in the diet, this might seem a little bit surprising that it's actually fat that's driving it, but that's cheese. People don't think of cheese as a fatty food, but most cheeses have more fat relative to protein than what comes out of the cow. So in that sense, you gain more on the fat side than you do on the protein side. The growth in the skim solid side is not, it's bad, but it's actually quite a bit less than on the fat side. So and especially now, since about 2012 or so, it would appear that we have given ourselves permission to be more indulgent. So we have cream with our lattes, which is actually kind of a big deal. The cream market has been amazingly crazy. We're perhaps choosing more exotic specialty type cheeses, which might be higher in fat. We're giving ourselves permission to eat regular premium ice cream and not, low fat or skim yogurt, et cetera, et cetera. And so this is starting to show up. Whole milk, for example, is the only category in beverage milks that are actually increasing in sales. Even though that whole category has got some trouble, whole milk is actually not doing quite so bad. This really pops out when you look at the trade side. So these warmer colors, red and orangish colors, are the export stuff. This is skim solids, this is fat solids. Green and blue, the cooler colors, are imports. This is, the higher one is skim solids, the lower one is milk fat. And basically what this is saying is when you go back to 1996, which is when we gave ourselves permission to have trade, that was the end of what was called the Uruguay Round General Agreement on Tariffs and Trade. It gave us the WTO structure. That was the first time when dairy started to approach a freer trading environment. Prior to that, the U.S. dairy industry had very little trade in either direction. It was about 2%, whether it was exports or imports. After that, we opened the door, and we started to first see a bump up in our imports, and kind of started asking ourselves, is that what we signed up for? But over time, the U.S. dairy industry, I think, really responded, and it got to the point where we were pretty good at selling simple products based on our quality and a competitive price, which is to say we were not a price leader, we were a price taker, but we moved some products. We're now starting to get to the point where we're really more competitive. We've got some established business relationships. People understand our quality a little bit better. We're not really, a price leader. We don't set the market, but we're starting to get a little bit more profitability in that market. We've got a long ways to go. Most of what we export is powders, either whey powders or milk powders, which are pretty simple products, but nevertheless we've gained a lot of share on that. We don't import much butter, maybe 5%. Export much butter, around 5%. And a lot of the cheese that we export, which is 5 to 10% of the total market, is actually following a restaurant that's going to another country. So Leprino Foods is the sole source supplier of cheese to Pizza Hut. Pizza Hut goes to Beijing and brings Leprino with it. Pizza Hut goes to Moscow and brings Leprino with it. So it's not like Leprino said, gee, let's develop a mozzarella market in China. Their customer developed a market for a product that requires their cheese. Prices. Because we are so dependent on foreign customers to buy our powders, it's not surprising that the U.S. price pretty much mimics what's happening around the world. So these red lines are the U.S. average price, national average price. These are done with very solid surveys. I mean, an average is an average, right? There's going to be some below and some above, but this is pretty high quality data. The bluish zone and the green zone are not so great statistical data. They're more like driving around and looking at the gas prices and then saying this is what the average gas price looks like. But they're indicative. And you can see that there's not much difference between what we call the international prices, which is what Europe sells to a foreign customer for, or what New Zealand sells to a foreign customer, and our prices. And again, this is because we sell such a gigantic share. Something like a half to 2/3 of the dry whey, maybe 2/3, upwards of 3/4 of the non-fat dry milk that we produce in the United States of America is sold to a foreign customer. So, of course, our prices match or follow the prices that other countries sell to those same customers for. When you look at cheese and butter, you start to see a different pattern. There's a general sort of tendency. If the world is going up or down, we kind of sort of follow. A little more on cheese than with butter. But you can see plenty of examples where the world was going down and we decided to go up. And it didn't last forever, but you can see places where something else is going on. And this is in no small part because we don't rely on foreign markets to sell these products remotely as much as we do for the powders. So the domestic market is more important in affecting what's happening with these prices than the world market. It's also the case that we do have tariffs on some of these programs, and our tariffs on butter happen to be pretty high. So the way the tariffs work is you have a maximum amount of product that you can put under a high tariff, and then after a point in time, that tariff goes away. This is when the tariffs are kicking in high. It allows us to have a high price. When you get to the part of the year where we've kind of exhausted that and we're into more of a freer trade-up situation, then those prices start to move. So some of this is reflecting tariffs that kind of go in and out based on our trade agreements. Okay, I'll spend just a wee bit of time on these prices. This is the price chart from USDA, and they're looking at the 4 commodities that are used to calculate milk prices under federal orders, but I'll just focus on this one. I don't remember exactly what the average price was in 2014, but it was probably somewhere around $20. The high point was 24. We've been in this kind of low trough. I call it the long scrape. It's not like the lowest prices we've ever seen, but holy mackerel, they're below average and they just don't seem to stop. We're optimistic about prices for 2019, but that optimism makes them just about as good as 2015. So good news is we think prices are going up. Bad news is it isn't going to really feel like they're all that high if we stay according to our expectation. The other part that comes into this is how much money do farmers make? Because obviously, if corn is really cheap, you can have a lower milk price and still come out okay. Turns out corn and soybeans are pretty cheap for maybe not so good reasons. And so we're kind of, based on our projections, thinking margins should be significantly improved from what they were in much of 2018. This is definitely in the sort of average zone. It's not happy days are here again, but it's better. So that perhaps will be the outlook. We are perhaps, maybe, days away from having a new farm bill, and it seems that we will very likely have a new version of the margin protection program, which is not a happy word for most farmers. But I would simply say, rather than just throwing it out in disgust, take a close look at the new program, especially if you're about an average size farm or smaller, because I think you'll find that they've been able to introduce some changes that are going to be very attractive for farms that are in that average and smaller size group, and those details will come out, of course, as soon as the bill is passed. And that, like I say, that could be days. So that's the end of it for me, and I look forward to your questions.
How have recent tariffs impacted agriculture in the Cayuga County area? So we'll start with Stephen.
I'm a generalist rather than I'm not a farmer, so we actually, the IBA, we get involved in all sorts of industries, but some of the things that seem fairly clear, soybean exports in the last year or so have been damaged by the tariff war with China. I think the milk exports that we had, Cayuga milk ingredients and so on around here, we've been having difficulty getting into Canada. I'm actually always surprised that the news tells us that it seems that we don't export milk products or dairy products to Canada, but I think last year the Canadians imported $470 million worth of American dairy products. So we're still exporting to Canada, but they've been putting up these barriers, and with the USMCA, some of those barriers might be coming down. So I think it might look good with the USMCA coming along, but we've still got to get a lot more detail about that to see how that's going. Generally, the tariffs on the agricultural side of things, it's a lot about China. I think that's where it's been hurting a little bit, and we've been seeing some declines in some of the products been exported over there, soybeans especially.
I'll lead right into that, Stephen. Thank you. I just did some math before I came here. Cayuga County last year produced 1.2 million bushels of soybeans. The USDA thinks that $1.65 of that was lost in the tariff. That's $1.8 million just in Cayuga County that was affected by the tariff. We estimate closer to $2 a bushel, which is $2.4 million, and that's just in Cayuga County. So that's just right off the top due to the tariff.
And that's just soybeans too,
That's
right?
just soybeans,
Yeah.
true. Yep. And based on the price movements because of that. So the financial effect is certainly real, and the biggest problem is it's still really hard to identify a number. To conclusively say it costs this amount of money is very difficult because the prices are moving all around. You don't know what was contracted before the tariffs or what's still left to contract, and the market's moving. So financially, we're still uncertain about the total dollar amount, but I think the biggest effect on our producers is the amount of uncertainty in the market now in making decisions. We're getting into the period where guys are going to start to decide whether I plant corn or beans or how my rotation works, and without this export market, China takes, we export 50% of our soybeans and China takes half of them, or in the past had. So that's 25% of U.S. soybeans are going to China, who today says we're not going to buy any. They did up until Saturday night, and there's some revelations there with the trade war. But the uncertainty and the skepticism from the producers as to how do I handle this from a marketing perspective, from a planning perspective, is the biggest effect. And I think what it's forcing people to do is wait. And that can be, as far as building a plan, that's the worst thing you can do, right? So the skepticism behind the trade and the lack of resolution has really, I think, been the biggest psychological factor for a lot of people, and it makes making a productive plan hard to put in place.
So the thing that I would start with is, I think it's really important for everybody to realize, certainly in the dairy industry, but I'll just say certainly in the dairy industry, that it doesn't matter if you're selling to a foreign customer or trade is really important in your region or not, because this is really literally the boats going up and down on the same tide. So when I showed you those red line prices, and I said this is non-fat dry milk in the U.S., that non-fat dry milk price drives prices in New York just as much as it does in California or Texas or Wisconsin. That doesn't mean it's to the penny the same number, but they're going up and down together. And it doesn't, whether we have any foreign customers or not is irrelevant to that part. If you're a farmer, you're in a federal order, your class 4, class 3, and class 2 prices are identical everywhere in the United States of America. They're exactly the same number. And the class 1 price goes up and down pretty much the same way, even though it's not exactly the same number. So it's kind of the boats going up and down on the tide. I would say that if you are engaged in trade and you lose that, it's a little bit like somebody put a hole in the hull of your boat while it's going up and down on the tide. So it doesn't mean there aren't consequences, but it's for a producer, it's it's really more the up and down thing. I would also say, in just, a very rounded way, the Canada thing, where they took away our ability to export to Canada by changing their internal prices, was a pretty significant blow for Cayuga Milk and Oatka, and also Grassland, which is a company in Wisconsin, but was imperceptible in terms of the U.S. market. The Mexican thing is about cheese, and that's about their retaliation against us for poking them in the eye over steel and aluminum. It has nothing to do with NAFTA. Zero. Nothing. Nothing to do with NAFTA. That's why the new agreement won't change the fact that Mexico will still not buy our cheese until Trump backs off on steel and aluminum. The China thing is mostly about powders. Whey, for sure, and skim milk powders. And, they don't need to buy powder from us. There's powder all over the world. New Zealand makes a lot. Europe makes a lot. And, of course, that has something to do with steel and aluminum, but also the whole spat. The most recent thing that says we've decided to go to our corners, sit down, put a damp cloth on our head, breathe a little bit, that's like a good thing. We're not hitting each other more now, but we haven't stopped hitting each other either. So it remains to be seen whether or not this results in something positive. It also remains to be seen whether or not in 2019 there is backing off on the steel and aluminum thing with Mexico. But again, that has nothing to do with NAFTA or USMCA or whatever you want to call it. So the Canada thing is far and away the smallest of those in importance to the dairy industry.
Can I just add, just to move on from the analogy of the tides moving, one of the things to also remember with trade wars, this is more of a tariff war than a non-tariff war. And if you're exporting, no matter what product it is, one of the big factors in anyone's exports from one season to another, one year to another, is the foreign exchange rate. So if you look at Canada, 2014, they were getting $1 US dollar for every one of their Canadian dollars. Now they're having to pay $1.34 Canadian dollars to get one of our dollars. So everything, and I mean everything that they buy from the US right now is 34% or 31%, I think today, on 1.31 to the dollar. It's actually 30% more expensive than it was 4 years ago. That's without any tariffs. So what happens with exporting is you get these foreign exchange rates that go up and they go down, and from 1 year to another you get an increase or a decrease in the volumes that you're selling. It doesn't stop people in Canada buying our products, but the foreign exchange has a big influence on it, maybe even bigger than the tariff. You're talking about 10% duty on some of the products. Who's going to care about that when you've got 30% on the foreign exchange? So whenever you're looking at the tariff side of trade war, just pitch in the foreign exchange side of things. Look at China. China's exchange rate with the renminbi has been softened so that actually their 10% import duty that their Chinese importers are paying actually isn't 10% because the currency has allowed it to now really be about 5%. So keep an eye on the foreign exchange. It's just not import duties.
I will tell you that the Canadian dollar jumped about 2 points after the USMCA announcement. So they are getting more competitive just on the news.
Yeah. So that's part of the equation. See.
Assuming it's passed by Congress, how will the recently signed USAMC agreement impact ag in the Cayuga County area?
I haven't got enough information about what the USMCA really is. I think we've got little bits and pieces. I haven't really been able to find enough real deep clarity with it. I would hope, and hope is not really substantial, but I'd hope that it looks like some of the quotas, the tariff quotas that Canada have, will be increased. That'll allow the door open to ship more in. Whether we do ship more in or not is to be seen. With Mexico and their cheese tariffs, maybe that sort of removes that. But as Andrew was saying, it's really about the steel side of things there. So I think we just got to wait and see. We get little bits of information from one day to another, and it changes around quite a bit. It feels like it should be a little bit better. I don't feel like it's world changing though.
From a grain perspective, nationally in the U.S., the Mexican piece is much bigger as our biggest corn buyer, exporter. The Mexican business and more openness in that market is a much bigger factor. But here locally in Cayuga County, I think if we can open more exports and raise prices for the milk products here into Canada, that allows some of the New York farmers here to expand, to grow a little bit bigger, and in turn use more corn and use more feed ingredients. So as grain, with grain becomes under more demand here because of local processors, dairies here in New York State, I think the grain guys also would see that benefit as well with higher prices.
As you might guess from what I said before, I don't think there's much. In fact, I think Cayuga County is more affected by Chobani than they are by Canada, which is to say not a hell of a lot. And the agreement, people that are really in the weeds with the language of the trade agreement are referring to the USMCA as NAFTA 1.1, which is to say not a hell of a lot different from the NAFTA we had in the 1990s. And in fact, it's kind of ironic because most of the parts that are different come from language from the TPP, which we also rejected. And which has nothing to do with dairy. So I really think the consensus is for dairy, positive effect, but small. And I would say, get on with your life because nothing exciting is going to happen because of that. Cayuga Milk Ingredients may have an opportunity to resume some sales, which could be important for them as a company. But I don't really think it's going to make a perceptible difference to the New York dairy industry. OATCA, too, farther down the road, but we'll see.
Okay. This next question is for Zach primarily, but if other people want to jump in, go ahead. What do you see as the main driver of the current low grain prices?
Okay. If it's okay, I'm going to kind of group it in with the.
Did you want to slide here?
Yep. So the main driver for low grain prices, and I put low in quotations up there because in the next slide we'll go into a little more longer term perspective to understand where we are today and kind of where we're going to head. But in the last few years, you've seen a number of different factors kind of reset us back down to the $3.50 to $4 level in corn. The main driver being the stabilization of the supply and demand fundamentals from the ethanol boom. From 2005 to 2008, we saw this huge demand from the ethanol industry come in to buy corn. Today they use a third of the corn supply in the United States, 5 billion bushels, and that happened in, 13 years. So during those first 5 or 6 years, the demand for corn was huge and the price absolutely spiked high. Couple in that with the drought in 2012, and you have very low stocks and always very high demand, you saw $8 corn. We are just now kind of the supply side is starting to offset that. We had $8 corn, everybody and their brother started to plant corn, and so the market kind of fixed itself. We were able to supply that higher demand of corn to the ethanol group, and also now the ethanol industry. At first they were operating in huge margins. There wasn't that many of them, and the demand for ethanol was huge. It was mandated by the government. Now we have ethanol plants everywhere. There's actually overcapacity for ethanol today. So ethanol plants hover at break even on price of corn and the price of oil and gas. So there is not this huge demand underlying behind the corn market to buy every bushel of corn that we produce for the ethanol group. It's much more stable today. The tariffs are definitely a reason, especially in soybeans, for just basically the uncertainty in the market. And I was talking to Stephen a little bit about this. One of the interesting things that we saw when China came in with the tariffs was this big switch of end destinations. So all of South America's countries that bought from them came to the U.S. and China went to South America. So at first there was really no lack of shipment from the U.S. They were just going to different people, all the people that had bought from South America before. Overall, by and large, you cannot have an export market without China. They're just too big. They're basically insatiable demand over there, and we expect that to continue to grow over the next couple of decades. But the initial effect was relatively light because we could kind of ship to some other spots, but now longer term we're definitely feeling that the effect of not having the world's biggest market. So that's definitely depressed. Like I said, USDA estimated $1.65, somewhere $1.50 to $2 is probably a fair estimation. And then another thing that really helped us reset was multi-year bumper crops. We've had 4 or 5 years in a row with record or near record yields and production. And that's across the United States. So while the demand is high and continuing to grow every year, we're just crushing it at the farm level. I mean, the technology that we have now to improve yields and increase production in adverse areas, you know, with precision and planting and stuff like that, stuff that used to not even be able to harvest it, now we're getting some production out of it. So those three things are kind of, I think, what reset us down a little bit lower to where we are now. And this is the chart I was talking about. So for the 60s and the 70s, you kind of hung out from $1 to $1.80. I mean, I talked to a couple of guys that said back, you know, at that time, if I sold 180 corn, I was doing real good. And then we had the embargo and prices jumped up. And then so you had roughly 20 years there, or 30 years of corn price between $2 and $3. There's a few outliers, the embargo when it dropped down, and then the drought in 97 popped up. But by and large, it hung in that range. And now we have reset into this little higher range here from 325 to 425, I think. March corn today is around 380, so you are sitting almost dead center in the middle of that range today. And you can see the kind of the 2012 drought spike there. But this range here is really where we see, where my button is, but that 325 to 420 range is what we see the supply and demand setting up for down the road for the next 4 or 5 years. There could be some black swans if we have any. Now that with the world corn supply being so much more tied to the price than just the U.S. as the breadbasket, there's so much more opportunity for weather issues in South America, Australia, the EU, all over the place. Yeah, go ahead.
What's the trend been in stocks to use ratio worldwide for?
Stocks to use. So on the bullish side, and some of the positive aspects I can talk about is this stocks to use and kind of this negative triangle here where, and this goes back to the 60s, but so we have the blue line is world's or U.S. stocks to use, the most volatile one. World stocks in the yellow, and then, or I'm sorry, total in the yellow, and then foreign stocks in the gray. So as we move through the 70s and 80s and basically into the ethanol boom, we start to tighten up the U.S. carryout with the world carryout. As the total grain flow is more important, as the U.S. grain flow is more important to the total grain flow, our carryouts start to match. So this trend to come down to a level where we are comfortable with supply, it's getting so tight where any issue, any drought, any black swan, what it may be, is going to have a massive impact like that 2000, like the ethanol boom, because we get so comfortable with our production and supply at this level that's very stable. And then if you have something that really disrupts the crop, the production side, you could drop way below this 10% and into dire needs, and that's when you have the price really rally. Was there a specific question on that?
No, I was just looking at the trend line.
Yeah. So yeah, we're kind of it used to be grain everywhere, and now demand is going up. So and the market's getting much more efficient at only producing what we need. I'm not going to produce a lot extra if it's not going to be worth anything. So we're getting very good at producing just what we need, and then we have an issue. That's when you'll see a little bigger explosion, in my opinion. So this is about our most bullish scenario that we have on the stocks to use, and then just overall demand. We're going to have to feed twice as many people by 2050. That's a stat I've heard over and over again. So food demand in the world is still very robust, and I think it will continue to be there, but we're great corn producers, so it's kind of a balance.
Could you go back to slide 6? One of the things here that I think is sort of interesting to note, which I think most people wouldn't really think about so much, is the impact of energy costs on that relationship. So the 1970s is when OPEC finally got its act together. It was created before the 1970s, but it took them a while to figure out how to accomplish their goals, and price of petroleum skyrocketed, and it created inflation throughout the supply chain. It was, that was the story of the 1970s, and pushed everything up, but corn certainly was part of that, and that was more about cost of production. That wasn't, we weren't doing ethanol back then. Now you get into this next tier up, and there's a pretty serious energy relationship now because we are using corn to make a source of fuel. But in both cases, the tie-in to the price of a barrel of oil is a lot more important than you might think would be the case.
And we've done a lot of studies on what is more correlated, whether it's corn to, or ethanol to corn price or ethanol to gas price, and it is by and large to gas price. So it doesn't necessarily mean, and that's, you know, another tough part about the ethanol industry, like I was talking about, they're basically breaking even is because the corn is cheap. Yes, it is, but oil's cheap. So it doesn't, there's the incentive up until, you know, and that's changing all the time. We did have a good oil spike here, but backed off. But the price of oil is much more important for an ethanol producer, but his main feedstock is corn. So corn is going to follow the oil price probably more closely than it follows the ethanol price.
Yeah.
My next question is for Andy, and I think you might have kind of answered this. What do you see as the main driver of low milk prices?
Well, again, you know, it's these subtle differences in how fast production grows versus how fast consumption grows. I don't know if you caught it when I flashed that USDA numbers on usage, but you know, you remember the chart. The sales consumption grows every year. It's not like it's retreating. Yes, you can look at certain segments. Fluid milk is the obvious one, where the results have been disappointing. But you know, by and large, cheese is more than made up for any of those other sectors that are retreating. So it ends up being a lot of small things. Maybe the flip side of that question is, what's it going to take to get things to a more comfortable position for producers? And the answer that comes kind of from the business school world is market coordination or supply chain coordination. We have to do, well, we can just roll the dice and see what the hell happens, but if we want to get a little more control of our price relationships, we have to give up a little bit of our liberty to produce whatever the hell we want and start to do the kinds of things that you tend to see more in fruits and vegetables, or for that matter, a lot of livestock, which is to say, you got a group of buyers that say, next year my business plan is this is what I expect to need, this is what I think I can afford, and then you have a little negotiation about that, and you say, okay, I know that for this volume, I can get this price, and I know that if I go over that volume, it's on me to figure out what the hell to do with it. That is not the way dairy has approached marketing. Unless we're willing to buy into that more coordinated mechanism, I think we're just going to see this roller coaster of prices continue. And in fact, I think it could actually be maybe even worse than it has been historically, in the sense of getting stuck at a low level. But in terms of saying it's trade, it's the price of corn, it's beverage milk consumption, it's almond milk, it's like, it's all of those things, but it's none of them more than the other.
Anyone else have any comments around? Okay, so now next question for Stephen King. What sorts of export opportunities do you see right now for the Central New York ag sector?
I started doing a little bit of research, and I found this amusing because I don't know if we've had people in the room. The USDA, they send out export forecasts and an export outlook, and I think we got a little challenge right now. Is that the short term is really difficult to see. The long term is much more difficult to see. The outlook they put out in October showed that there was going to be a $3 billion increase in exports of agricultural products for next year. And 1 month later, the 29th of November, they actually put it to $3 billion down. So we get a swing within a 4 or 5 week period of the estimates, the forecasts that the USDA are looking at for exports of also, this is wheat, corn, coarse grains, soybeans, and such like. And then over the weekend, we've seen that President Trump has now announced that there seems to be some warming of the relationship with China. And I've even read I think it was the BBC News mentioned that maybe President Trump is going to force the Chinese to purchase a certain multi-million-dollar, billion-dollar amount of agricultural produce. So whatever they put in the forecast 2 weeks ago, or 1 week ago, probably is going to be rewritten, and they say they're going to rewrite it in February 21st of February next year, but I think I should probably do one next week. What's happening is it's just changing, and it's really difficult to try to determine what the overall trend is going to be. China's got a big influence in that, but some of the things that come out of this report, it shows that wheat's looking to continue growing. Corn's going up. Looks like the prices of corn from this may be increasing as well. Things like livestock, dairy and poultry are going to decline by about $200 million. But then beef and pork is going to take up that $200 million there. So there's a lot of interesting things in this document that show you what the trends are. And if you're looking to sort of select crops and things, there's obviously a lot of guidance in there. But I do think that we've got the trade war, we've got the political situation that's going to be shifting all of this around quite a bit. The exchange rate is something that is always going to be volatile, and maybe if the trade war calms down next year, that's going to shift the dollar around, hopefully more positively towards us. But it's a little difficult to really put your finger on what's going to be good, because in 2 days' time, President Trump might say something else, and we've got another shift going off in another direction. So the instability is there, and as Zach was talking about, I think everyone's trying to plan for the future, but it's more challenging to plan for it right now. That's probably about my take right now on what the opportunities are. There's some crops that seem to be good, that maybe are worth focusing on, but I think there's probably some previous years where people have been able to be more comfortable about their choices of where they're heading.
It seems like it'll have to be a specialty type of product. Something that we're not doing today that would be going to a different outlet, whether it be Canada or Mexico or the EU or something like that. Some of the non-GMO stuff, beans, lentils, peas, those kinds of things that the other importers can't buy out of Chicago for 50 cents cheaper than they are here in New York. So some of those specialty items, I think there's room to grow. Whether there's room to export them, that's probably yet to be seen. But that seems to be in our business. If there's transitions away from corn or soybeans or larger grains that have been historically the most popular, they're into smaller grains, cover crops, hops, some of things like that. So those would be the advantages I would see to the export market. Would be something, a niche product.
Actually, another thing on this is that $3 billion is just by coincidence, but the US is forecasting $3 billion worth of loss of soybean exports in this 2019 thing. But if President Trump's fixed everything yesterday, maybe that $3 billion is back on the table. So is that something that people should focus on? Is like, let's get back into soybeans and let's keep supplying. So that's just one of those areas. There's a big part of this variance in forecasting right now. Who knows? Does anyone know? Anyone want to guess?
Let us know. Chicken.
Well, it's a little challenging. Right, yeah, but that's I'm good.
All right. So the next question for Zach. When do you think grain prices will rise? I mean, kind of answered a little bit.
Yeah, it definitely feels like the markets have readjusted from the last couple big market-affecting moves, whether it be the ethanol coming in or really the trade tariff here. So I think really what you need to do is to find how we can be more competitive logistically with some of our competition into Southeast Asia. So I think everyone has identified China number one, but all of Southeast Asia as they transition from more grain-based diets into protein-based diets. We are competing with Russia, the EU, and Australia to get all of those ingredients or those feed items to China. And so I think our biggest issue is going to be the supply chain to get there, and how do we do that more efficiently than everybody else. So capturing this additional demand, we know the demand is going to come. Capturing that additional demand is going to be the goal, the focus for ag exporters here in the United States.
I think the the other thing that I might add to that is we'll get a more accurate reading when we start seeing the planting intentions and planting reports, but everybody is expecting that farmers are going to switch soybean acres to corn acres, which of course reverses what they had done the previous year. And so that action, if it happens, should take some pressure off of soybeans, but then of course you got corn you have to get rid of. And the other thing is true for dairy, it's true for all of U.S. agriculture. What's going to happen in Argentina? What's going to happen in Brazil? What's going to happen in Ukraine? What's going to happen in every other place of the world that makes stuff that we make, and generally does a pretty good job of it. Kind of a big boon for us is that Argentina had a bad corn crop. We thought we were going to get a little help from Brazil on soybeans, and it turned out not so much. So all of those things can impact what we experience apart from what we do internally.
But the price structure now has transitioned so quickly to the global demand picture than it had in the past, with exports being such a big piece of it, especially in soybeans. You can't just look at U.S. weather and production and supply and demand here and say, okay, the demand's going to go, price is going to go up. There's so many other factors now that we have to pay attention to, that a lot of them don't have trends. How does Trump have a trend? No, yeah, it's crazy. I mean, you can't really plan for something like that. So the uncertainty is really hurting it, but I think that also can provide a lot of volatility in when something would happen. If something did happen, there's going to be a huge scramble because nobody was prepared for it. So it could be explosive for sure.
Okay, the next question is basically the same for Andy. When do you think milk prices will rise? And I think you kind of answered it.
Yeah, well, actually, we saw a little movement in 2018. The market is expecting a $2 rise from January to December of 2019. If you look at the cyclical behavior in milk, which still exists even though it's narrower, 2020 would be the next big year. Doesn't mean the whole of 2020, but it's kind of moving towards 2020 being the next high year. The thing that you kind of said this with your USDA thing. I get a lot of stuff across my desk every day, 3 different reports, and they're reporting this, and you open it up, and it's Tuesday morning, and it goes, oh, boy, it's awful, and this market is down, and that market is down, and the grasshoppers ate the kumquats, and it's all awful. And then you open it up on Thursday and go, oh, no, it's all good, it's great, the grasshoppers all died, and it's all fine now. And then next week, it's, oh, gosh. And so basically, what you see is almost no price movement, but an industry trying to figure out what the hell's going on. And it's up and down and up and down and up and down and not actually really going anywhere. If you look at the behavior on the Chicago Mercantile Exchange, where people are trading dairy contracts, and these are people that are like in a serious business. They're not playing games, and they're trying to do their best to figure out what position should I be ready for. What I see is a bunch of folks looking at each other saying, wow, market's really been down. It's got to go up, right? I mean, it has to go up. Where else can it go? So, okay, yeah, it's going up. And then you go, maybe not then. And so we keep revising the near-term forecast to be less bullish, but we still are bullish farther out. So 3 months ago, we thought March of 2019 was going to be really great. Today, maybe not. But we think fall of 2019 is going to be pretty good. So there's this kind of feeling that it's got to get better. We're just not sure exactly when it starts. And I will say, I think we're going to continue to see a rising market heading into 2020. I don't think, it's going to be nosebleed high, but it will certainly be an improvement. And, if we can keep corn, somewhere around 350, 375, we should see average profitability on farms, which is, sort of a fictional number, but average profitability somewhere in the average range.
Okay, next question for Stephen. What's the best way for a company to get started with exporting?
Come and see us. That's a good start. Really, exporting is it's very short-sighted if you just go in for a quick win. If you really do want to get into exporting, start thinking on the long-term vision for it. It takes a bit of time to get it going. Once it's going, the momentum really can keep going for a very, very long time, and once you've got it right. So you need, with exporting, companies need to sort of figure out what they want to commit to their business, how much human resources they're going to put into it, how much financing they're going to put into it. But really, at the end of the day, you need to start with an export plan. And to start with an export plan, you've got to go one step back from that, because you've got to figure out what the knowledge is that you need to actually get that export plan put together. There's a lot of different things with anything from documentation, there's logistics, there's intellectual property, there's all sorts of contracts, there are finding buyers and trade shows and all sorts of different areas that you need to consider to get exporting. And if you haven't got any experience at it, the best thing to do is to reach out to people like we are, at the IBA, who can help put you on the rails. There's a lot of resources out there. You don't have to contact us. There's the US Department of Commerce, the USDA have their own exporting resources, the US Export Dairy Council, or the US Dairy Export Council, I can't remember which round it is. There's resources out there that can help companies to sort of get established. If you come to the IBA, however, because we're the hub, we can connect you with all of those different resources later on. We're really building a plan, really being intentional about it, and really figuring out that you've got to apply some resources and some time at it. One of the little gotchas that you have with this is that sometimes people think that, I think farmers tend to think a little bit more long-term than manufacturers perhaps, but you've got to think of managing your time expectations and how much effort and how much time it's going to take to get the initial sort of rewards coming back. And if you can manage those expectations, and you've got a product that is exportable, that's another thing we can help you with, then the world is your oyster. There's a lot of US companies that are not just farming, but manufacturers out there use exporting as a great strategy to strengthen their US business. What they do is they have sales in maybe 10 or 20 or 30 different countries, and then whenever you get an economic downturn here, or you've got something somewhere else, it's an insurance policy type of thing. But there's a lot of learnings that you can get from overseas. Sometimes American companies can actually make more profit on export sales than they can on domestic sales as well. So there's a lot of different areas to look at. The key is just getting connected with people that have resources. We've got a lot of mentors in our own stable of companies that we connect with. So we have companies that have done it, that have been there, that can also help you through that as well. Lots of things out there. Lots of money out. 95% of the population is outside of the US and 75% wealth. So if you want to make more revenue, there's a place to go.